3, 2, 1. Welcome to the show.
All right. Welcome to the show. Checking last minute
Caught Jerry off guard.
Yep. It's an interesting week. It's going to be, I don't know if it's the first down week of the year, but got a little pullback, which is fine. You know, the market doesn't go up in a straight line. It doesn't work that way.
It doesn't always go up.
Nope.
And when it doesn't, that's why we're here.
Ideally, you can look at what's happening in price and volume and some of the other technical indicators and get an idea of whether or not price is pulling back in a constructive way or is a collapse happening. And that's where you take into account, seasonality bias and Elliott wave counts and support and resistance levels and all that to try to get an idea, draw a line in the sand that says if it gets below this line, then I'm out.
Right.
As it's coming down, how is it acting as it's coming down? Should I expect it to find support or no? It's going to go blowing right through that line.
What are the other data points? Right.
Right.
Yeah. We were just looking at something right before, and sometimes it's obvious, right? So you're looking at the price, right? You're looking at the line, chart, but you're looking at the rest of the indicators, data points, however you want to describe it, and it's almost like glaringly obvious, oh, but not if you're just looking at price on either on the chart or on the screen. If you're just watching the market and it's it's 3,900. That's just one piece of the story, right? Which is what we try to teach people, right? And so go look at the chart, and you got all these other data points, and then you're like, oh my God, it's obvious. The momentum's going away.
Yeah.
It's not always obvious, but when it is, it is.
Yeah.
It's it's right there in front of you.
Right. So again, it's like riding a bike. The more you practice, the stuff kind of jumps out at you, and you can see it. So okay.
What do you got for us this week?
So the Fed, right? The Fed has been...
The dang old Fed.
It used to be we talked about earnings. Everybody got all excited on CNBC and Bloomberg about earnings and earnings season. And now it's completely overshadowed by any time, particularly the Fed chairman, but anytime anybody from the Fed speaks anywhere in the world, that's where Bloomberg focuses. And it drives the market short term. And so the Fed funds rate is one of the most important things. That's what's happening. The Fed is changing the Fed funds rate. And so we're going to just, if you don't already know what that is, we're going to kind of do a highlight of what the Fed funds rate is and what it affects, and how ultimately it affects, the moving up and down of the TSP funds. And then this whole idea of a Fed pivot. I'm going to talk about that, kind of show what the definition of it actually would be according to Wikipedia or Investopedia. And then I got a couple of pretty interesting charts about the Fed funds rate / pivot and how it has affected the S&P 500 over time. And then, of course, what does all this mean for our TSP accounts? And then we'll take a look at the TSP fund charts. So Fed funds rate, okay, it's an interest rate set by the Federal Reserve to indirectly manage interest rates, inflation, and unemployment. So it's indirect. You don't, when the Fed raises interest rates by 0.25%, like it did at the last meeting last week, it doesn't mean that your credit card rates go up 0.25%. Doesn't mean your mortgage rate goes up directly 0.25%. It's indirect. So what exactly is the Fed funds rate? It's a target interest rate that's set by the FOMC, the Federal Open Market Committee. They meet 6 or 8 times a year. It's usually a Tuesday, Wednesday, and Wednesday at 2 o'clock is when they come out and have the Fed announcement. So the target is the rate that commercial banks borrow and lend their excess reserves to each other overnight. Okay, so it's very technical, and that's what it actually is. It's how much banks, the rate that banks charge each other to lend money to each other overnight. Okay. FOMC, it's a policy-making body of the Federal Reserve. Meets 8 times a year, sets the target rate. Not part of monetary policy. We're not going to talk about that. And the idea is it's used to promote economic growth. So impact of the Fed funds rate, right? This is all we really care about. Fed funds rate, one of the most important interest rates in the U.S. It affects monetary and financial conditions, right? Which in turn have a bearing on critical aspects of the broader economy, including employment growth and inflation. So as the Fed raises rates, the cost of borrowing goes up. So as companies have to borrow more money, their earnings come down. If they can't support the added borrowing costs, they look to do layoffs. When they do layoffs, that becomes the employment piece. When people get laid off, they're not spending as much money. That affects the growth piece. And when the Fed raises rates, it brings inflation down. So that's why we're always hearing the Fed looks at the inflation number, and they're talking about the employment number also, because they know if they raise rates so inflation comes down, it should also create unemployment. And so last week, when employment was really strong, that number came out on Friday, that's when the markets kind of went really off the rails. Basically because it showed that so far the Fed's raising rates did not affect unemployment. It didn't increase unemployment, which now has everybody thinking that gives the Fed all the more room they need to continue raising rates. Okay, so the rate, this is really kind of the most important piece. The rate influences short-term interest rates, right? It's not direct, it's indirect. Influences short-term rates, everything from home mortgages, car loans, credit cards, as lenders often set their rates based on the prime lending rate. So the prime rate is the rate that banks charge their most creditworthy borrowers. So your mortgage rate is going to be something like the prime rate plus some amount, right? And your credit card loans and everything else. If you read the fine print on the back of a credit card statement, it's the prime rate plus whatever, 10 or 12%. And yeah, so investors keep a close watch on Fed funds rate. Stock market typically reacts strongly to changes in the rate. A small decline in the rate can prompt the market to leap higher as borrowing costs for companies get lower, because they know as soon as the rate that companies have to use to borrow money, if that rate goes down, earnings go up. It's a direct correlation. So the stock market goes up in normal times. Many stock analysts may pay particular attention to statements by members of the FOMC to try to get a sense of where the target rate may be headed, which is all that one sentence is all the crap you see for the past 6 months on Bloomberg. Everybody's pontificating about whether the Fed's going to raise rates, pause raising, Fed pivot, all that stuff. Okay. So what does the Fed funds rate actually look like? If we go back to the 1950s, okay, we had a steady higher highs, higher lows, right? We have a steady uptrend in rates until the top in the early 1980s when Paul Volcker, I'm sure most people have heard about, if not lived through, raised interest rates to really try to kill inflation that was real bad back then. Ever since then, we've had lower highs, right, and lower lows until we get down here and at the bottom of the financial crisis here. Fed pushed rates down to basically zero. It was 0 to 0.25% was the target range, and we've pretty much stayed there. We had this tick up, which they called the taper tantrum, in 16, 17, 18. And then after COVID, the rates came straight back down, stayed at basically zero until this most recent rate hike. So if you look at the chart, this is the nominal, meaning it's not algorithmic. So if you look at it and you say, well, this uptick that we had in rates, it's not that dramatic. I mean, we've had, bigger really upticks in terms of the rate itself. So why is this such a big deal? This is the logarithmic view of that same chart. So on a percentage basis, this move that we just had over the past year and a half or so is the biggest move on a percentage basis in the history of, Fed funds rate. So what the concern is that it takes time for all this to work its way through the economy. And so if companies borrow, back here when rates are low, if they have to refinance that debt, now they have to pay it up here, and it's 4 times what they paid down here. So if they were just, making products, making payroll, companies doing fine based on debt at 0.25%, if now they have to pay debt at 4%, a lot of them won't be able to do it. And they call them zombie companies, and they're the ones that people expect to be going out of business here as we go forward. And that's part of the big problem for the macroeconomic view of things right now. It's why everybody's expecting the market to roll over at some point. Okay. So the Fed pivot, right? This notion that when the Fed changes from raising rates to lowering rates, it's going to be good for stocks, right? So Fed pivot occurs when the Federal Reserve reverses its policy outlook and changes course from expansionary, which is what we had been in. Expansionary is when they lower rates, right? To contracting, which is tightening rates, or conversely from contractionary to expansionary. Okay, so a Fed pivot typically happens when economic conditions have fundamentally changed in such a way that the Fed can no longer continue its policy stance. Okay. So how does it work? Fed's a central bank, meaning that it can change the nation's monetary policy. So Fed has a dual mandate, right? It has to maintain price stability and full employment. So if inflation rises, the idea is unemployment falls, the economy may overheat, so the Fed will tighten, right, or constrict monetary policy. So it raises interest rates, tries to slow economic growth and let the economy cool down. Likewise, if inflation is low and unemployment is high, then the Fed can loosen monetary policy to try to keep us out of a recession by lowering rates and putting more money into the economy. So where we are right now is inflation is high, coming down, but inflation is high, and employment is very low, or unemployment is very low, right? So they're in kind of a trick bag because they're not in one of those two categories. So once monetary policy has been set and implemented, it can take several weeks to months before the effects of the policy are felt on the economy. And so that was the thing about the last chart, where we had such a huge rate increase over the past 2 years, and we really haven't seen it yet play out in the economy. So once they are, the Fed typically maintains its existing policy to some degree to maintain stability and avoid spooking the markets. Okay. If the fundamentals of the economy shift dramatically, the Fed is forced to reevaluate its position and may decide to pivot, right? That is to reverse its monetary policy stance. So if interest rates are low and the Fed is employing quantitative easing, which it had been doing for a long time, it would pivot by increasing interest rates and tapering, right? It would do quantitative tightening. A pivot in the other direction would entail the reverse. And the reverse of that is quantitative easing and decreasing rates, right? So in either case, doing so can be disruptive in the short term as market expectations and business forecasts are revised in light of the new policy. So it's easier for me to explain everything on a chart. And so this is a chart of the Fed funds rate in black and the S&P 500 in orange. Okay. So if we go back and take a look at it from left to right, there's kind of a lot of things to talk about in this chart. I drew in these lines, okay, and they basically correspond to the tops in the stock market, in the S&P 500. So the Fed's raising rates, so the market's doing really well back here in the 90s, right? Tech boom is happening, and the Fed starts raising rates to try to cool the economy down, right? They level off here, raising rates, and that's the top of the tech bubble. Once the tech bubble rolls over, the Fed starts lowering rates because price stability and unemployment are the two mandates to the Fed. So the market starts tanking And so the Fed starts lowering rates. Okay. Once the market bottoms out and starts to recover, the Fed starts to stop lowering rates. And now the market's doing well. The Fed can raise rates because it doesn't want the economy to get too overheated. So we have this recovery into 2007. And the Fed's raising rates, flattens out, right? Because it doesn't want to over tighten. And then the market rolls over and the Fed starts lowering rates again. Okay, the Fed's responding to what the market's doing. That's what its mandate is. It's not responding directly to the stock market. It's responding to price stability, right? So that's generally how it works. Then we get down here to the bottom of the financial crisis. The market recovers, right? But the Fed does not raise rates. It keeps them at that 0 to 0.25% all the way into, 2015. So now the Fed says, okay, market's starting to get a little bit overheated, starts raising rates, market keeps going up, no problem, keeps raising rates, it's all good. We have some of this taper tantrum stuff in here, and that's actually why the rates started coming down before COVID. It was because of this taper tantrum that was going on right here. But then once COVID hit, rates come down because the Fed is trying to support the economy. The market comes down, and what happens again? The Fed does not raise rates, even though the economy is absolutely going through the roof, right? The market's crushing it. So now we get to a point where the market starts rolling over, but the rates are basically at zero. So in every other time back here, where the top of the rate cycle is the top of the market, now we have the top of the market is the bottom of the rate cycle. So we have the Fed raising rates, the biggest raise in rates it's ever done as the market is tanking. Right? So it's an extremely unique place to be in terms of the history, at least back to the 1950s. So this is the big question, right? Since we haven't seen the effect of this rate move, does that mean when the economy does start to feel the effect of it, the market really crashes, right? That's the big concern. Yeah, so there's no answer to the question because we're in a place that we've never been. And so I put out something in the public group this week that was like, if you are having a hard time with the market, you're not alone.
Right.
Nobody knows what's going to happen going forward. I mean, the setup is for the thing to completely tank. And a lot of people think that's what's going to happen. There are other possibilities. If unemployment stays low and inflation starts coming down on its own, then the Fed doesn't have to continue raising rates, but we still have the whole last 2 years of rate increases that haven't trickled through yet. So it's nobody knows what's going to happen.
Right.
And so all we can do is respond to what price actually does and go back to the technical analysis, support and resistance lines, moving average lines, and make reallocation decisions based on what actually does happen.
Yeah, I mean, that's no way. We are not approaching it any different, right? It's always nice to know why. It's great to know why, but you're not always going to know why, right? So we have to focus on price, volumes, the other indicators that tell the story, right? To confirm the trend change or however you want to describe it. And so it really does get pretty simple, though. So if you just close out all of that stuff, right? So we listen to all the chatter, we listen to all the things, but at some point you have to just focus on your lines in the sand,
right?
Where they're going, what's your plan,
right? You
doesn't really matter why the plan did what it did, or why the market did what it did. What's your plan for when the market does what it does?
Yeah,
that's it.
Yeah, that's right. That's right. I just wanted to point this out because I think the Fed funds rate is something that is, until the last couple of years, nobody really talked much about it.
Yeah.
It's kind of esoteric, and people, but it's a huge
now
deal.
everybody's talking about it.
Everybody's talking about it. Yeah. So
Hopefully,
hopefully,
it's a huge impact.
Oh, it does. Yeah, without a doubt. So hopefully that gives you guys at least a cursory understanding of what the Fed funds rate is and how it affects pretty much everything from housing. I mean, that's another good example, right? As rates go up, as Fed funds rate goes up, mortgage rates go up. But housing has come off a little bit, but it hasn't come off all that much. As people get unemployed, which is what the Fed expects as it raises rates, people won't be able to buy houses. Yeah. So there's so many things, and it all kind of comes together, not at the same time, but it rolls, right?
You got to really pay attention in that micro and macroeconomics class.
Yeah, exactly. All right, so the TSP fund charts. I'm going to do one here that I don't usually do daily charts on the public group, but I'm going to do this one just because there's a lot of churning going on right now, and we're at a kind of an interesting place, and I'm going to do the regular weekly charts. So, like we just said, you have to have a plan regardless of why things happen. You want to be able to see it when they actually happen on the chart. So, in this case, this is basically a 1 year and a couple of month chart, daily chart of the C fund. All right, so here we are back at the top here in January 2022. I have the 20-day exponential moving average line in blue. Okay, so 20-day moving average line in blue. You got relative strength, RSI, CCI, and MACD, right? So if you were trying to figure out when to get into the market, this is the best way that I've come up with to do it on a daily basis. Okay. When price gets above that 200-day moving average, RSI gets above 50, CCI gets above 0, and MACD turns positive. When all four of those things, they don't all happen on the same day, but when all four of those are in place, that's a buy trigger for our methodology. Okay. It's only happened 5 times since the top in January 2022. It's not 100%, and you're definitely not getting in at the bottom, right? But you're getting in at a place that it's most likely that price continues higher. Once you make that decision, you get in, then it's the opposite to try to figure out when to get out, right? And then, of course, you're taking into consideration that we only get 2 moves a month and the noon rule and all the rest of it. But so when the first trigger was back in March, RSI crossed above 50 on that day. CCI had already crossed above 0 the day before, and MACD had crossed positive like the day before. They almost all happened on the same day, and that was the buy trigger. We got it again at the end of May. You get RSI crossing. The biggest one really for me, well, they're all important. You have to get above that 20-day moving average line. We got above it. We churned there for a couple of weeks and then came right back down below it. And we also you can see RSI hanging out right there at the 50 line. And then once we broke down, it broke down below it. So in the big scheme of things, you want to be in the stock funds when RSI is above 50, right? When it's below 50, you don't want to be in the stock funds because this is what you're getting. So CCI is good. RSI and MACD are my 2 kind of go-tos, and that's how you would do it. So we had the low in October. We got above the 20-day. RSI gets above 50. CCI had already done well, right? It's already well above 0. MACD had already crossed positive. So one of the things that I look at on the buy side, a lot of times MACD will turn positive first. So it's a leading indicator. Not all the time, but when MACD turns positive, as the market is still coming down, I'm really kind of watching for a reason to get back in, right? Because I already got one indicator that's already triggered. And then once CCI comes up, there's the second one. And I'm just waiting for confirmation for price to get above that 20-day moving average line. Okay? So that's kind of how I look at it on a day-to-day basis. And it's the same thing in the reverse, right? So for example, right now, as of Thursday's close, we are just above that 20-day moving average line, still above 50, but coming down on RSI. CCI still above 0, but coming down. And MACD is still positive. It's looking like it's rolling over, but it's still above that 0 line. So we're looking for a reason at this point to sell, right? We don't have a confirmed sell trigger yet, but that's what we're looking at. So you don't want to sell too early, right? If we looked at this day right there, for example, if I can do that. Let's see. So we had a little tick down through the 20-day moving average line there, but RSI didn't get below 50, and CCI didn't get anywhere near zero. So, price dropped quite a bit, but it got support there at that 20-day moving average line and kept moving higher. So that's why we have all these these are the four indicators that I think are the best that work for me. And if they're not all in place, then you don't have a buy trigger or a sell trigger. And it just takes a little bit of discipline to hang in there when you don't have all those lined up. Okay. So that's how you do it on a daily basis. On a weekly basis, it's really the same thing. It's just that the volatility is going to be more on a percentage basis, right? Because you're looking at a weekly chart instead of a daily. But if you only want to manage your TSP on a weekly basis, which we kind of think is a good idea because you only get 2 moves a month, and you have to deal with the noon rule. So if every week you looked at this chart of the S&P 500, as long as price is above that 20-week, in this case, 20-week moving average line, every time it corrects, it comes down and finds support there and keeps moving higher. And you can see RSI is above that 50 line, right? Until it breaks down right there in January. And it was the same breakdown there in RSI and MACD crossed negative, right? So the indicators all lined up to sell there in January on a weekly basis. And so now as we go forward into this bear market, what I'm looking at here, one of the biggest things, Con and I had talked about it, we have this low in June, and we have this lower low in October. In terms of MACD back here, it was lower here, but higher in October. So the momentum is increasing even though price is decreasing. It's a divergence. And so it puts you on notice that the trend is getting ready to flip, which it did. And so if you looked at it on a weekly basis, MACD crosses positive there. Price gets above that 20-week moving average line there. And RSI is just above 50 there. So that's a good time to get back in. This right here, you might have gotten spooked out. But what happened? MACD never crossed negative. So while we have this would look like a sell signal in December on a weekly basis because it's below that 20-week moving average line, we did get RSI a little bit below 50 there for a minute, but MACD never turned negative. So it would have held you in that position, and then the market continued higher. So it's tricky, but that's how you do it, both on a daily and a weekly basis. S-Fund, same kind of thing. You got a low here in MACD, a much higher low here, even though lower prices in October. So the S-Fund obviously is getting ready to start moving higher, even as prices are coming down. And then once we got above the 20-week moving average line here, got above 50 RSI, MACD had never turned negative back here. So you had the trigger from the MACD back here was still in place. iFund. I put the green line in here for the iFund. It was a huge up week, right? That's also the week that RSI got above 50 and MACD had turned positive 1 week prior, just barely. So what I was trying to do is figure out a way if it would have made sense to get in like this week so that we could have gotten that week's gain. And you could have looked at it and said, well, I think, MACD's turning, and you can play around with these indicators all you want. It would have been just as easy if we came up to that 20-day moving average line and rolled back down. MACD or RSI would not have gotten above 50. and the market could have rolled over at that point. So unless all those factors are in place, that's what I want to see, and that's why we got back into the I fund back here. F fund, it's all the same kind of idea. We got above the 20-week moving average line here. RSI got above 50. MACD had already turned positive back here, so we got a pretty good buy trigger for the F fund. And if we threw in some Elliott wave counts, we had a 1, 2, 3, 4, 5. So that would mean we should get some kind of a B, C back up to the prior 4, which would be somewhere around 104, and that's what our projection was if we had stayed in the F fund to get out of it, somewhere around there. It's where we'd expect some resistance and potentially for the market to roll over. The only other thing I wanted to point out about this, we had talked about wicks, I think, maybe last week or the week before. You can see right here that we have wicks above the body. Generally, when you have wicks above the body over time like that, it's bearish. There's a lot of, the price isn't moving much, but it's bearish because as the bulls are trying within the week, right, are trying to drive prices up, by the end of the week they're back down, and so it's bearish price action. We're still above that 20-week moving average line. We don't have a sell trigger yet, but at this point, if I was in the F fund, I would be looking for a reason to get out of it, not a reason to buy more of it. Okay.
Questions.
You
kind of stayed out of your way today.
Yeah, no, that's okay. It was kind of a nerdy show, but I think the Fed funds rate. Well, the Fed funds rate is not what I think. It is a critically important thing to understand.
It's a very important topic, and it's one of those things. Like again, this is an educational show, so we want to talk about things that you guys might be thinking about, but you're only hearing it from one kind of viewpoint, and how these things affect how we manage the TSP is really important.
Yep.
All right. If you have questions about today's show, you can put them in the comment section wherever you find the video, and you can always hit us up at support@growmytsp.com. The customer service folks will be happy to forward it on to us.
Yep, absolutely.
And hope you guys had a great week, and hope you have a great week coming up. We'll see you soon.
There we go.